Okay, Ben, I'm asking you to unmute.
Hey, Dale.
Hey, Ben, my trading warrior brother.
How you doing, pal?
Good. Great to hear your voice again, Ben. A lot of stuff has happened since you and I talked. I don't know, how long ago was it?
We talked probably around 3 months ago. I think it
Feels
was,
like 3 years.
yeah, I think it was in early May.
Yeah. Okay, so do you recall how to screen share
Yeah,
here
let
in
me
Zoom?
share. Let me share the screen here.
Everyone stick around for Ben. Take a look at some of his market geometry and cycle work. Okay, so go
So
ahead, take it away.
yeah, today what we're going to do is we're going to take a journey to the 70s and back. And Dale, we're not even going to need to use any psychotropic drugs to do it. So
It's going to drop. All
even
right,
though
go ahead.
even
Go
though it's
ahead.
Friday, we're gonna stay sober.
All
We're
right.
probably going to need some psychotropic drugs to go through the experience, though.
There's no doubt about that. If this stuff comes to pass, it's going to be quite the ride. Quite the
Yeah,
ride.
a bad
So
trip.
yeah,
Had one of those.
well, it doesn't have to. I guess it doesn't have to be a bad trip if we're prepared and if we,
Great
if we
point.
put ourselves in a position to not be hurt and to probably benefit from it. I think it can be okay. So
Yeah,
that's
build machine gun turrets outside your house.
yeah, boy, that's crazy. Anyway,
All right, so go ahead. Take me back to the 70s. I'm
yes.
ready. I'm
So
flashing back.
with Dale for the last year and a half, we've been following this 70s analog about which is based on some of the work I've done showing how the present day circumstances we're going through are connected cyclically to what the planet and humanity experienced in the 1970s. And we'll go through and we'll show, and I keep adding to it. I keep adding sort of, as events unfold, I keep adding more similarities that I notice based on events that are occurring now with events that happened in the past. In January, when Dale and I got together, we were discussing sort of the outlook, as one does in January, about what to look for and what to expect in 2020. And the three main themes that I hit on were volatility, and I put a check mark on volatility because we've certainly had that, not recently, but obviously at the beginning of the year we had tremendous volatility. Inflation.
The VIX is sure trying to come out of the hole here. Had a pretty good day until the fade yesterday.
Yeah, no question about it.
Yeah,
and that's one of the charts I'll review later on is the VIX, and it's sending a message that we got to listen to. So volatility is a check as far as I'm concerned. Inflation, stagflation. Haven't seen it yet, but we're going to go through and look at the economic numbers and look at the situation and why it's a pretty high probability event that we're going to get this combination of stagnant growth and rapid price appreciation in the economy. And then the thing that I've been beating the drum on is commodities. And I'm going to show you a series of charts across various commodities that all have a very similar shape and similar pattern, which points to potentially explosive moves in the next 6 to 18 months.
Yeah, the grains have a heartbeat in the last few weeks.
Absolutely. I'm in the grains. Yep, yeah. I'm in the grains. I like them. I think we're at the beginning of a move out of multi-year, meaning 5 to 10 year bases, where the ballistics calculations just show really explosive moves and much higher targets, and we'll talk about that. So back to the 70s. Here we go. What happened in the 70s is happening again now. And the thing that people have to understand about cycles is we all want order. The human brain wants order, and it wants to make sense of everything. The cycles repeat, but they don't repeat exactly. They rhyme. We get the same types of actions and reactions. Events don't always unfold exactly the same, but there's a certain rhythm and a certain rhyme to it, to where you can get a decent idea of what's going to happen in the future based on the cycles that's happened in the past. And right now, the connections between the 70s and the present day are numerous and growing. The ones with the check marks are the ones we've discussed on previous speeches. A lot of it is the comparisons between Nixon and Trump in terms of our leadership in the White House and how they interacted with different constituencies and policies they had and what they're doing. The most telling one that can show you that it's just not chance or it's just not curve fitting that's going on here is we've had 4 presidents impeached in over 250 years of being a country. Two of them are connected with this cycle. So Nixon got impeached and Trump got impeached. There's only 2 other presidents who've been impeached. And I think that's a really strong piece of evidence. The ones without the check marks at the bottom are recent ones that I've sort of gone back and looked and said, okay, do these make sense? Are they connections? Is it fitting the scenario that we're talking about? In the 1970s, oil prices quadrupled. The Arab embargo, the OPEC embargo caused major problems and major stagflation, and we'll get into that later. But I was like, well, we haven't seen oil prices quadruple here. But what remarkable event did we see in oil prices?
Went negative.
That's right. We saw the.
You know what I'm noticing, and I'm going to let you go, but that a lot of the events are the polar opposite of what happened. Like, let's say Nixon China was the opening and the beginning of the relationship, and Trump China is the end of the relationship. Oil quadrupled, and this time it went negative. And when you look at the 70s, and as bad as it felt, we were going into a major bottom and cycle into the early 80s. 1982 was a low in the market.
Mm-hmm.
And so we're getting the opposite now in a few of these things, which could mean that we're entering the end of prosperity. Before we were going a bad time into a good time, and now we're kind of going from a good time into what might be worse times. What do you think?
I think that is a fantastic observation. And it's coming from a guy who clearly understands cycles. They're not always exactly the same, but you can see sometimes it's a polar opposite connection.
Yeah.
And that's what we are seeing with certain events. And
okay.
Your analysis is spot on. You're a cycle guy at heart. That's what it tells me.
Yeah, 50 years.
One of the other interesting ones that has come up recently was the Cold War. Right? We were in a Cold War with Russia, had nukes pointed at each other. As a young kid in elementary school, I remember the ridiculous drills of getting under your desk in case the Russians launched bombs at us, launched nuclear bombs. But there's no question right now we're in a Cold War with China. When you have the countries closing each other's embassies and kicking out diplomats, that is emblematic of being at war but not shooting bullets. And that is the situation with China. And we hope it doesn't end up escalating into a hot war, but we know, I think right now we know we are in a Cold War. The one I'm on the lookout for is the last one here. Stagflation was a part of the 70s. It was high inflation, sluggish, low or negative growth. We are looking at a setup which will review the pieces that are in place for a similar type of occurrence where we are most likely going to have sluggish growth and we're going to have high inflation. So we're going to see how it plays out, and we're going to see the evidence, and we're going to look for signs that it's coming to pass or signs that it's not coming to pass. And with any of these things that I'm looking at and the things that I'm saying, it's all about probabilities, right? There are no certainties in the markets. There are no certainties in the future. All we can do is look at the evidence, look at the cycles, and say what's probable to happen, what's likely to happen, and then you position yourself that way. You manage your risk, and as events either confirm or deny it, you make adjustments. You don't doggedly hold to your position and say, I'm going to be right, I'm going to be right. It's not about getting being right. It's about getting it right.
If you don't learn how to change your mind, you won't have any change left. W.D. Gann.
No question about it. So the headline on this slide is, anybody who has ever worked with analogs understands this. Analogs work until they don't. And so I took a twist on a very famous saying, and basically added it to this, which is all good analogs must come to an end. At some point, they stop following. This is the S&P from 72 to 75. The last time we were together with Dale, I'll show you the chart of the prospective path we were looking for. The X here shows where we stopped following. We were making a high. I fully expected a rebound. I played the rebound, same as Steve described, into the 2850, 2950 area. Got short through options, looking for the next leg down. We didn't get it. The analog stopped following. The main reason we did not get it is because of the intervention of the Fed and the government response. And I do have to say the policy response was probably almost perfect. The way they handed out money, the way they gave out money, the liquidity they provided, the policies that they implemented solved the short-term problem. And it basically had the effect of pushing the cycles out. You can't eliminate the cycles because remember, the cycles are things that affect human perception and human behavior. And that can't be changed. We react and we do things based on hardwiring of millions of years of evolution.
How much time do you think they bought us? 2-3 years?
I'm not sure yet. I put in here the arrow just to show where we are in time cycle wise. So we're by no means are we out of the woods. And I'm going to show you what the cycles are calling for projection wise, and then we have to look and see, get confirmation from price before we dive in and take action. But the elimination of those benefits and the failure to produce this next stimulus, I think, is going to create and push us into the next phase of this cycle, which is they solved the short-term liquidity issues. But they didn't solve the solvency issues, and that's the big thing, is that there's an amount of debt in the economy that can't be serviced with a reduced level of economic activity, and what they did by shutting down the economy is they've killed 40 to 50% of small businesses. And so in the aggregate, if you look at it on a whole, we're going to be growing at a much slower pace, and the economy is going to be smaller simply because it's going to take time to replace that supply and replace those that amount of GDP that's been lost. And so that we're going to go into it, but that's sort of the part of the stagflation. That's the stagnant, right? That's the stag, is that we're not going to be growing as rapidly. So here's the this was what we were looking for the last time. You can see the S&P was making a lower high. We had poked through the megaphone, and we thought, maybe we're going to see, this sort of pattern play out per the analog. Well, obviously that didn't happen. Here's what happened. We were at this point. We had a sharp pullback. It looked like we were at this point. We had this sharp pullback, and it looked like the analog was gonna follow through, and we were going to head on down. And instead, we reversed sharply. We made new highs. I'm thinking we're going to make much higher highs than we are right now. There are some, and I'll go through these in the next few slides. I'll show you some of the targets that we can look for. But once this blow off is done, and we'll show you not only price targets but timing targets, this is the pattern we're still looking for. This is the pattern that the cycle is calling for. This would be a pattern associated with stagflation if we get that. So we got to keep our eyes out for evidence that inflation is kicking up and the economy is not kicking up to the level it previously was. We'll do a little lesson in geometry and a little lesson in cycles here, and we'll walk through sort of some potential timing for this top and this blow off top that we're looking at. What you're seeing here is a calendar day. This isn't ES, sorry, this is S&P, so that's mislabeled. Yeah. This is a calendar day S&P chart. What we've got here, these yellow lines are measuring solar degrees. So here we did one, we said, what if we go from top to top, high to high, 180 degrees. The high would have been last week. Well, clearly we exceeded that, so that's not gonna mark the end of this run. But we said, what if we go low to high, and we go to the March low, 180 degrees, takes us out to September 26th. So the wide end of the range of where we think how long this blow off could last is approximately another month. I mean, we could grind up or shoot up like a rocket for all of September and the last couple trading days left in August. Another number that we're looking at is simply 180 calendar days. 180 calendar days takes us to September 19th. And interestingly enough, I said, what if we did 180 calendar days and 180 up in price? That gives us a beautiful 180 by 180 cycle, which would take us to 2617. Do I think that's probable? I think it's
36.
I'm sorry, 3617. I think that's possible. I think that's very possible. And if you look at it, you know, it's only what 125, 130 handles. I mean, it's not an unrealistic number. So keep an eye out for that timing and that price level, and that's something else.
Nice chart, man.
Earlier than that, this is a proprietary cycle that I have, and its timing is the 5th of September. So with these three, you can see we have a window in here where we're coming up on a time where we have good probabilities in our favor that we may put in a top. And so how do you handle this? Do you sell it as soon as it gets there into that window? Do you just take a dive in? You got, what I like to do is I look to see what's the price action going into it, what's the price action coming out of it. Do you see a perceptible change? Is the reaction to news changed? Is the reaction to events changed? Has the tone of events changed? And as you observe and see those things and you watch price, you can get an idea as to the effects of the cycle. But at least, you know, the listeners and everybody watching this can know that starting in early September and going through the month of September, you want to watch for signs of change. Do we stop busting through resistance with ease? Does support stop holding? Does support start failing? Do we start getting stuck under old support? Those are the sort of signposts that you look for to be able to get a good gauge on what's going on in the change.
What a great chart, Ben.
Thanks.
Everyone, take a screenshot and have it on your workstation throughout September. That's my suggestion.
So here's another one that we look at to get an idea on pricing. You know, where could we possibly top out? What are some levels to watch out for and take note of? This is on the ES basis. The numbers here, some of you will recognize some of them. There's a few Fibonacci numbers in here. There's Lucas numbers. There's golden rectangle, golden triangle type ratios that I've put in here. Again, it's just another way of getting an idea of where are decent levels where I really want to pay attention and watch price action and see if we get some sort of difference, some sort of change, some sort of turn, especially if it's within that cycle window from the 5th of September to the 26th of September. The one up at 3628 is interesting. We've already hit the one here at, you know, roughly 3,500. So I've seen some people, Nargis, who does really good work, posted some stuff about, you know, hitting the top of her megaphone. So, you know, we're there price-wise. We're not quite there time-wise yet. So keep, you know, watch both sides of the street before you cross. Look both ways. Look behind you, because things could start changing and start happening at these different levels. Here's another look at geometry that can give you an idea of some levels where you might want to consider that we've topped out, or take some off the table if you're long, or potentially initiate short positions. On the ES weekly here, 3518 is a level, which is this red bar here. We can also get up into the 3600s, and if things get crazy, even 3700 if it really gets going. So the idea is to watch these various levels, see how price reacts, and then that gives you information as to what potentially could be coming next. I heard you talking about the VIX earlier this morning.
Yeah.
I've got this chart in here because there's an interesting divergence that's happening right now. S&P made a new all-time high, and the VIX is not anywhere near the lows where we were in February and January when we were making.
And also, Ben, there was a huge gap on the way up in February, and it be filled at 18. And even with all these new all-time highs, it didn't even eat into the gap.
No. The VIX is telling you that there are participants in the market that are interested in protection, and
they're buying fire insurance now, aren't they?
That's exactly right. And you need it before the fire starts. So
yeah.
Pay attention to that. It's telling you that there are issues. People that are smart people think there's issues with the market and this level, and that the VIX is signaling something loud and clear. Inflation and stagflation. Let's talk about this, because this is part of the thesis that much like the 70s, we're going to see inflation and sluggish growth, or that dreaded combination of stagflation. The first thing we have to do is we have to talk about what actually causes inflation. You know, there are two different sides of inflation. One is that there's excess aggregate demand. What does that mean? That's a fancy economics term, but it means the economy is either growing too fast, or there's too much demand, too much money chasing too few goods, right? That's where we have things are running hot, basically. The second one is where there's cost push factor, where you have supply side issues. So if there's the price of oil rises dramatically, oil is a component in many, many products in the economy. Because the prices of oil goes up, the prices of those goods that oil includes get raised by the suppliers simply because they want to recover their costs and potentially, hopefully, be able to maintain their margins. I have this little bullet in here about the grocery store. Anybody that's been to the grocery store in the last 5-6 months, doesn't matter what the Fed says, it doesn't matter what CPI or PPI or any of these other numbers they give us, go to the grocery store, you'll see inflation. There's incredible price increases, which is one of the reasons why we're interested in grains and the commodities. Commodities are beginning, the prices of commodities are beginning to leak their way down to the consumer. And the grocery store is a perfect example. I'll give you another great example, and it's a stagflation example. I went and got a haircut for the first time last week since January. Because the woman who cuts my hair opened up her shop again and started taking people. So I was talking to her, how's business? What's going on? When did you start up? We started, modestly in April, but we really didn't start cutting much hair until within the last month. And I said, oh yeah. I said, how's business? Well, what's it like? She says, 50% of my customers haven't come back. And so I was like, wow, so your business is cut in half. And she said, yeah, pretty much. I said, do you think they'll ever come back? She goes, some of them, no, maybe I'll get some of them. And so we then chit-chatted about just other stuff. And at the end of the haircut, I go to pay for it. And she rings it up. And I look at the price and I hand her the money. And I was like, I started doing the math. She raised prices by 15%. And
you were lucky.
Yeah. So
my guy doubled it.
Yeah. So, but here's a perfect example of the stagflation, right?
Right.
Price is up dramatically, but her business is down 50%.
Oh, Forex gal is saying you should get a hair whiz or a Flowbee to cut your own hair. Right? Is that what you're saying, Forex gal? All right. You come over and give me a haircut.
I got one of those problems where when I look in the mirror, I get all screwed up because it's the inverse, so I don't even want to try that.
Yeah.
So now let's talk about stagflation. What causes it? Stagflation happens when a central bank expands the money supply at the same time as the government constrains supply with fiscally restrictive policies. And so let's talk about what that means. and through examples, you'll understand it. In 1970s, oil prices quadrupled. That's that supply side cost push inflation, right?
Yeah.
At the same time, Nixon froze wages and prices and instituted a 10% tariff on all imports. So he fiscally restricted the economy by those moves, while at the same time, what happened with oil prices caused massive inflation. The combination gave you stagflation. Now, are we seeing something similar today, or is it rhyming in some sort of way? Well, I think it is. Present day, the Fed has printed $3 trillion. Any way you look at it, it's inflationary, right? It's more money chasing goods, chasing assets, chasing investments with the same amount of supply. That's inflationary. At the same time, Trump shut down the economy due to COVID-19, and we're not coming back to where we were for a long time. So we've got supply restrictions going on at the same time as inflationary conditions exist. That is a recipe for stagflation. Now let's look at the numbers, the economic numbers, to see if they support it. This is the Fed's balance sheet. Shows the massive increase in the flattening out. This is the inflationary part right here. This is inflationary. Next, M2 money stock. Inflationary.
Yeah.
Velocity of money. This chart amazes me. The velocity of money is currently lower than it has been any time, dramatically lower than it has been.
Even with all this printing, isn't that deflationary?
This is what the way I look at it. It's not deflationary, but what it is this is going to cause it's not going to have the bang for the buck that they think economically, because people aren't spending the money. The money's not circulating.
They're saving.
They're saving it. And what happens when you do that, you don't spend it, you're not going to get the economic growth that you expect. It's a stagflation recipe.
Okay.
Let's look at a couple more.
The stag part of it.
That's right. Here you got the unemployment rate. We've bounced off the lows, because remember, this is the rate of unemployment. So the higher it is, the worse unemployment is. But we're still, if you look at it from a technical analysis standpoint, we're still higher than we were at the last recession, at the peak of the last recession.
We're testing it.
We're testing it. But this again means subdued growth. It's the stagnant part of stagflation.
Okay.
Job openings, similar story. We've bounced back to the 2016, 2017 level. If this doesn't get back near up in here, our economic growth is going to be nowhere near where it was when this whole thing started. Personal consumption expenditures, nice bounce. Probably big part of that was due to the stimulus. But again, 2016, 2017 levels. It's going to be hard to grow like we were if these numbers don't improve. The last economics chart I'll show you is, here's the CPI from 1970 to 1980. So for the decade of the 70s, more than doubled. I'm not saying that's what's going to happen again, just that I think, given that Powell wants it, you got to look at what are the powers that be want, and what do they not want and will not allow. They want inflation. They will not allow deflation. They're going to do everything in their power to ensure that we get inflation. And given that fact, we as investors and as traders need to position ourselves to benefit from that. So what are some stagflation strategies that you can employ? Some of these are ones that I learned from a mentor. I was just a young kid in the 70s, but I was very interested in investments and money and how the economy worked and all that. And this friend of my father's took me under his wing. He was a super successful guy, lawyer, entrepreneur, banker, developer, did it all. And he had a playbook for the 70s, and part of that is this playbook. In a stagflation, what you want to do is borrow as much money as you can at the current low fixed rates. And why do you want to do that? And why is it sort of the opposite of what everybody except the really smart people and the really smart businesses are doing right now? Everybody's panicking. They're hoarding their cash. They're paying off debts. They're doing everything that a responsible person about money does. But if you really want to profit from a stagflation, if this is what's coming, this is how you profit from it. You borrow as much money as you can at current fixed rates, because ultimately you're going to pay back principal and interest with dollars that are devalued, debased, and less valuable. And what are smart people doing now that we can see, that we have evidence of? Despite the COVID-19 driven panic and recession that we've had, global bond issuance is at a record high, all-time high. Companies like Apple, who many people will argue, super smart company, most successful, most valuable company in the world, they've borrowed over $8 billion this year. And they have over almost $200 billion in cash. Why? You say, why would you do that? Why would you borrow money if you're sitting on $200 billion in cash? Because they're paying 2.6% to borrow for 40 years, and they understand what's coming. They know what's coming. They understand that that money's going to be cheap, and the money they're borrowing at 2.6% fixed today, they're going to be paying back with a lot less valuable money in the future. So what do you do if you borrow money at current fixed rates? You buy real assets. What are real assets? They're physical assets. Gold, silver, commodities, real estate, land, equipment, buildings. Anything that's a physical asset is going, if we get this kind of inflation that the Fed is stoking and what the cycles are calling for, those things will all go up in value dramatically. The last quote you see here is from my mentor, and what he said. He's at this time in the 70s, he said, "What you owe in real estate today is what you'll be worth in the coming years." And that's because physical assets will appreciate, and the dollars you borrowed will depreciate.
What a great presentation.
Thanks, Dale.
Is that the wrap?
Nah, not yet. I got a couple more to show you.
Okay.
So buying real assets. Here's what happened to real assets in the 70s. These are compounded annualized rates of return for different asset classes. Just take a look at them.
Yeah.
Look at the winners. Stocks and bonds did okay, right? They did all right, 6.1 and 6.6%. But look at the returns on the hard assets.
Yeah.
It's dramatic. Let's run through the charts real quick. Here's the Dixie on a monthly basis. All these are going to be monthlies because I want to look, when you're talking big picture and you're talking big cycles, you got to use the telescope, right? You got to see what the landscape looks like. Could they break this? Yeah. Could we get a really strong bounce in the dollar? Yep. I think that's more likely right now than a total collapse at this point. I do think at some point we're going to see the dollar get trashed, but a bounce not out of the question. Here's euro at a pretty important spot.
Yeah.
Major resistance right here. If we break through here, we got to run much higher. If we fail here, you're going to end up somewhere in here.
So let me ask you this. When it comes to trend lines, Ben, how many closes do you need above or below a trend line to make it viable? Just one or a couple?
One is good enough for me. Obviously, if you get a couple, you get stronger conviction and more confirmation. Okay. But I generally like to see one entire candle above, or one entire bar above.
So the monthly close in a couple of days is going to be pretty important.
Pretty darn important.
Yeah.
Yep. Aussie. Same situation. Super important resistance right here at this 7280 area. We're above it right now. So if we can get above and stay above, like the next month's candle can stay on top of this, that's pretty bullish. If it can't and it fails, we're heading back down again. Gold. Interesting chart on gold. I like using these circles when you get something that goes parabolic, because it can help define, the arc can help define the slope of the move and keep you in the trade. We're starting to poke out here, and we're poking out at resistance. This dashed line, in addition to these solid red lines, can be support and resistance. So do I think gold goes much higher longer term? Absolutely. Is there some concern on the shorter term for gold? Yes. I would not be chasing gold here. There's really strong support at 1800. If we should see that again, it would be a very, very strong buy on a monthly basis. Here's silver. And I want you to look at the silver chart for an important comparison. This silver chart looks exactly like the next 6 or 7 commodity charts I'm going to show you. It's just further along in the move. We've had the breakout, and look at the dramatic breakout when you get out of these big bases.
Yeah.
There's a 6-year base, right? 6-year base in silver, and look at the move you get. And it's what I think.
The bigger the base, the bigger the launch into space.
That's exactly right. Simple ballistics.
Yeah.
Here's an interesting trade that I think is setting up and you were on this early, Dale. I have to give you credit. A few weeks ago, you were talking about higher rates, and it has manifested in a big way, and I think the charts are supporting it. So we had this dramatic move up in the 10-year bond, right, defined by the circle, and now we've gotten out of the circle. When you break out of the circle, you either got to launch, continue to launch, or you head down, and I think the 10-year is heading lower, based on the chart.
What yield? About 120 or?
I didn't do it on a yield basis. I did it on a 10-year price basis, more around like the 133, 133.26, 134 area, right in here.
Thank you. I'll figure it out.
On the 30, same type of situation, right? Yeah. The 30's actually come off much longer. We had the high up here on the arc, and now we're dead on support. So this is
steepening.
This is a critical spot for the 30-year. If we lose this 176, 175 level, the trapdoor to hell is open, man. Much higher rates on the long end. If we hold here, we could bounce.
Yeah.
So now let's look at the commodities, and remember the silver chart. Remember the silver chart. Here's beans. Soybeans yesterday had a big, this is a monthly, but yesterday's price action broke us out of a 4-year downtrend.
Embryonic.
There's your 6-7-year base, and we're breaking out. I think it could do what silver did, but in its own way, with a big launch. Wheat.
Protein gold.
Wheat looks the same, doesn't it?
Yeah.
6-7-year base, higher lows, right ready to break out of this 7-year downtrend.
Farrell's commodity broker is buying it. You know who that is, right?
No, who are they?
The Pharaoh of Egypt, his commodity broker is Joseph.
yeah, that's right. They had a little wheat.
Forex Gal's talking about lumber, and I used to watch it and trade it, and it's like at 700-800 they can't get lumber to build houses.
Again, think about it. It's the supply
chain.
That's right. It's a supply restriction.
Yeah.
And what do we get? We get massive price increases and inflation. Corn, same chart, 6-year base.
Yeah. Some great opportunities setting up.
You want some coffee in the morning? How about this?
Yeah.
Coffee broke out of a 9-year downtrend line.
Yeah.
Sitting on top, huge base, ready to go. If you have coffee, you got to have some sugar.
Yeah.
Same pattern. How about some
Where
cotton?
sugar went to.
Yep. Yeah. How about cotton? Want some cotton for your clothes?
Yeah.
Look at that.
Yeah.
Same pattern. And it's not unrealistic to look for moves like this coming out of a base like that.
Yeah.
And so that's multiple commodities. We've seen it. Crude, people are interested in crude. Now, crude doesn't base. As you know, crude is so volatile, it spikes. But I wouldn't be, there's a similar pattern here, right? Are we going to get some sort of crazy supply dislocation in crude and a spike in crude. It's possible. It doesn't have.
I actually think crude is going to be part of the stag rather than the inflation, at least for a while longer.
And you know what, Dale? I think that that's a good possibility, because if you think about how crude has reacted, it's been the inverse in this cycle from the 70s. So that may happen.
So we went from minus 38.
Yeah.
I mean, do you measure your fibs from minus 38 to 44? I don't know. I do it from, anyway. Yeah, I think this is going to be part of the stag. Yep.
And so the last thing I want to do is, because I know there's a lot of currency people out there, is we're going to start posting some currency stuff for people, trade patterns that get initiated by our system. These little circles show when they get initiated. If there's multiple circles, it's because there's a continuation trade. And the main thing about this pattern system is it shows the beginning of a fast trend. The trend could be weeks, could be months, because we're doing this on a daily basis. The main thing is it's not a corner-seeking pattern. You're not trying to pick tops and bottoms. You're trying to find the trend when the trends kick in, and it keeps you out of chop. So I'm just going to give you 3 quick examples, and then we'll be done. This is for the Aussie JPY. First triggered here. Then we had a continuation here. Next one is the Euro. Triggered here, continuation here, and you can see they're affected on these pullbacks, right? They get set up, and then you enter when you get these kind of pullbacks, and the trends line up and the signals generated.
Nice.
And then there's one for the pound yen.
Okay.
And that's it.
Ben, thank you so much for putting all this effort into this presentation. Everyone thank Ben for putting energy into it. A lot of people come on, they just wing it. And, the sign of somebody who is effective in life is someone who prepares. And that's always been a problem for me. Anyway, listen, Ben, my trading warrior brother, a lot of people really loved it. What's the best way for them to stay in touch with you, follow you?
Yeah, I've got the Twitter handle up there. If they want to follow me, I post everything there. I try to be responsive. DMs are open, and just trying to hold myself accountable for what I say by putting it out there and helping people if I can.
Really a pleasure, buddy, and I hope you and your loved ones remain untouched, and that pips rain down on you this fall season, and I'll get a hold of you a little later in the day. We'll get you on the books for after the election and see what America looks like in November.
Sounds great, buddy. I think that sounds fantastic.
All right, Ben, thank you very much. You really are my trading warrior brother and a friend. Pretty cool. And I want to thank everyone for their attention. This one's worth watching again, in my extremely accurate and humble opinion. So everyone, remember, don't just count your pips or your grain or your coins or your shares. Count your blessings, and we'll see everyone on Monday. Enjoy your weekend. Adios, everyone. Thanks again, Ben.
Thanks, Dale. Take care.